Hello everyone, this is John Van Welden with Van Welden Financial Group. This is a special update we're sending out to all our clients and friends in light of the CARES Act, which Congress recently passed in response to the current coronavirus situation we all find ourselves in. As you know, our holistic approach to retirement planning means we don't just manage money, but we consider all the critical aspects of your retirement planning needs, including long-term tax planning. So I want to give everyone a brief overview of some of the key provisions of that act that we feel are most likely to affect our clients and others of you receiving this message. Specifically, I'm going to touch on the 8 points listed in the email accompanying this video. That is the effect of the CARES Act on the following. Number 1, 2019 tax filing deadline. Number 2, individual stimulus checks. Number 3, RMDs, required minimum distributions from qualified accounts. Number 4, suspension of the 10% early withdrawal penalties from qualified accounts. 5, enhanced charitable contribution tax rolls for 2020. And number 6, forgivable payroll loans for small businesses. Number 7, payroll tax relief. And number 8, net operating loss carrybacks for small businesses. So those last 3 will apply to small business owners, but the rest should apply to most all of you. There are certainly other provisions in this act, but these are the ones we feel are most likely to affect most people. This video isn't meant to be exhaustive, but rather to give you an idea of the key provisions that might affect you and a general idea of how. We encourage you to discuss these items with your tax preparer or lender as appropriate. Number 1, the 2019 tax filing deadline and income tax payments postponement. So the normal April 15th, tax filing and payment deadline is automatically postponed until July 15th. There's no need to file an extension, and there's no limit to or penalty for this extension, regardless of the amount of taxes that might be due. Number 2, stimulus checks. The stimulus checks that have been getting so much attention are actually an advance on a 2020 tax credit. The determination of who will receive checks will be based on whether or not you have filed your 2019 tax return. If you filed your 2019 return, it'll be based on that income. If you haven't filed it, it'll be based on your 2018 tax return. Now, if you're a single taxpayer whose AGI was under $75,000, you'll receive the full amount of $1,200. If you earned over $75,000, then it'll be phased out up to $99,000 of income, at which point you'll receive no credit. Now, if you're married filing jointly, you'll receive the full amount of $2,400, and this will also be phased out up to an AGI of $150,000. Children 17 and under will receive $500 each. Now, since these credits are actually in advance for tax year 2020, someone who retired in 2018 or 2019 may have been over the limit for those years, so they won't actually get an advance, but they will get the credit when filing their taxes for 2020 if their 2020 income is below the threshold. Now, number 3, we want to talk about suspension of RMDs. The Act has effectively suspended the required minimum distribution for qualified retirement savings accounts for 2020. This means you're not required to take a distribution for 2020. There will be no penalty for those who choose not to take their RMD for this year. A word of caution, however, many people's knee-jerk reaction to this will be to immediately suspend their RMD if they don't need it, for living expenses, that is. But I would encourage you to think twice. Although you may realize a short-term tax benefit by not taking an RMD you don't need, you may well compound the long-term tax cost of postponing your 2020 RMD. Remember, when we look at doing comprehensive retirement planning, our goal is to minimize lifetime income taxation, not just this year's. And one of the ways we do that is by spending what we call our worst money first. As our clients know, our worst money is usually qualified tax-deferred money. While tax rates are low as we've ever seen them right now, deferring those payments till later may actually cost us more money. And though some advisors might suggest you defer taking a withdrawal from an account because it may be down in value, remember that may actually be the best time to take the withdrawal, especially if you don't need the money for monthly expenses, but instead are moving that money into an after-tax account. You'll essentially be able to move proportionally more of those assets out of your taxable account than if the value were higher. It's the same exact principle we use when we're planning for Roth conversions. There's a big difference between money you're withdrawing to spend and money you're withdrawing to simply reposition. So if you think in terms of a Roth conversion, converting funds from an account that's taken a hit allows you to convert a proportionally larger amount of those taxable funds over to a tax-free account. Because again, we're not spending that money, we're just repositioning it. Number 4 is a 10% early penalty withdrawal waiver. This is up to $100,000. In essence, the CARES Act simply waives the 10% penalty for early withdrawal funds from a qualified retirement savings account, including IRAs, as long as withdrawal is deemed a virus-related distribution. This applies to withdrawals prior to age 59 and a half. Specific rules limit this to $100,000, and it must be in a financial hardship situation due to the implications of the coronavirus. These distributions will still be taxable, but Congress is considering spreading that tax liability out over the next 3 years, so 2021 and 22. There's been no final word on that yet, but that appears to be the case. Now, this is not something we recommend doing if you don't need it. But on the other hand, if you need it, then it's certainly a nice break. Charitable contribution changes. It's number 5. The CARES Act provides for a $300 above-the-line deduction for charitable contributions of cash to certain charities for 2020. Now, this is in addition to the recently increased standard deduction. So if you don't itemize, you would normally not benefit from an additional $300 charitable contribution. But this means that you can take up to $300 directly off your income, even if you're not itemizing, over and above your standard deduction. And if you are itemizing, there's an opportunity that's even bigger, because this act phases out the threshold for cash charitable contribution limits for 2020. For cash gifts, the threshold is normally up to 60% of your AGI. For 2020, you can deduct up to 100% of your AGI. Now, be very careful, because these rules don't apply for non-cash gifts or for donor-advised fund donations. They only apply to cash gifts directly given to qualified charities. There are also 3 other provisions that apply to small employers or those who are self-employed, which were subject to closure or significant revenue reductions during the crisis. These are mostly intended to directly encourage employee retention. Now, this won't apply to many of you, so I won't get into too much detail, but it will include small businesses and sole proprietorships, including any part-time consulting businesses. So if it does apply to you, or if you know someone whose business has been directly affected by the suspension, feel free to forward this information to them. So here we go. Payroll protection forgivable loans. For businesses under 500 employees, if you own a small business, this is going to be very beneficial. This will be implemented through the Small Business Administration, so speak to your banker or approved SBA lender for details. But here's an overview. You can get a loan for up to 2.5 times your average monthly payroll for 2019. You're not required to make a personal guarantee, and you're not required to provide any collateral whatsoever. So again, this applies to those who are either self-employed or a sole proprietor. So you don't need to be incorporated. Now, most importantly, this is a forgivable and tax-free benefit. So normally, if you take out a loan and it's forgiven, you have to pay tax on the value that's forgiven. But in this case, if you qualify, not only is the government going to forgive that loan and not require you to pay it back, but they'll also not require you to pay tax on the value that's forgiven. And in order to qualify for forgiveness, you have to use the funds for payroll, rent, mortgage, or utilities within a specified time period. And currently it appears that time period will be about 2 months, so 8 weeks. So let's say your average payroll in 2019 was $10,000 a month. You'll be able to borrow 2.5 times that amount, or about $25,000. Then as long as you use those funds for payroll, rent, mortgage, or utilities within that 8-week time frame following the loan, it will be forgiven and you'll never have to pay it back. Again, this is aimed at helping employers keep people working and keep wages as intact as possible. Now, there are certain restrictions, so definitely review those with your lender. One of those restrictions being that it's limited on a $100,000 per employee per year cap rate. So the second relief for small employers is payroll tax relief. Part A of this provision provides a refundable payroll tax credit for 50% of qualified wages paid by eligible employers during the crisis. In other words, they can simply postpone paying their portion of payroll tax. This credit's available to people or employers whose operations have been fully or partially suspended as a result of a government order limiting commerce, travel, or group meetings. This is also available to employers who've experienced greater than 50% reduction in quarterly revenues, measured on a year-over-year basis. Now, Part B of this provision is the deferral of employer payroll taxes. So those were related to payroll taxes payable for 2019. Now, for payroll taxes due for 2020, you're going to be allowed to defer and pay those over a period of 20, 21, and 22. And lastly, the net operating loss carrybacks. Now, in the past, when a business had a net operating loss, they used to be able to carry it forward or backward within a certain amount of years. But the 2017 Tax Cuts and Jobs Act eliminated that ability to carry it back before 2017. Now, this was important because we had higher tax rates back prior to 2017. So the CARES Act now is allowing for up to 5 years carry backward. So think about it. Now that many businesses might end up having a business loss for 2020, rather than have to carry that loss forward or only back a couple of years, it may be beneficial to carry it backwards to 2015 or 2016, when you may have had a larger profit and when your tax rates were higher. So definitely discuss with your tax professional. The downside is it will require an amendment to your previous returns, but it may be very worthwhile for some of you. So that's it for the special update concerning the CARES Act and how it might affect you. Please feel free to forward this to anyone you know who might benefit from the information, perhaps someone who may not be working with an advisor that takes the kind of comprehensive approach we do. We'll keep you posted as things unfold, but in the meantime, on behalf of all of us at Van Weldon Financial Group, stay safe and healthy. Thank you.